Hello and welcome to Earnings Echo. We put together the most important information about SentinelOne. Today we are looking at a company trying to pull off, well, a really difficult maneuver. They are essentially cannibalizing their own legacy product to catch the AI wave.
Right, and doing all of that while trying to satisfy Wall Street's relentless demand for cash flow.
Exactly. So if you are holding this stock or, just watching the cybersecurity space, you need to hear this. Let us jump right into the Q1 FY 2027 hard facts. Give us the numbers.
So Q1 shows some immediate acceleration. Revenue came in at $277 million, which is up 21% year over year.
Okay, and what about the recurring revenue?
Total ARR hit $1.163 billion, so up 22%, and non-GAAP EPS landed at 4 cents. Plus, management actually raised their FY 27 guidance.
Up to what?
They're projecting revenue between $1.195 and $1.205 billion, and operating income going up to $115 to $125 million.
Right, but with top-line acceleration like that, I have to question the profitability timeline here. Is this growth actually translating to the bottom line fast enough for the market?
Well, the margin expansion actually confirms it is. Their non-GAAP operating margin hit positive 4%.
Which is a 550 basis point year-over-year improvement, right?
Exactly, 550 basis points. But the real story is the segment shift. Non-endpoint solutions, meaning cloud, data, and AI, are now approaching 50% of total ARR.
Wow. Okay.
Yeah, and net new ARR hit a record $44 million, up 55% year over year.
Wait, we need to focus on that AI narrative because their prompt security ARR nearly doubled sequentially. But I have to challenge this. Are they actually capturing new AI workload protection budgets, or are they just cannibalizing their legacy endpoint sales?
The data strongly suggests net new market share. Management specifically highlighted a U.S. state government deal that they won purely because of AI security compliance.
Okay, so it is actually driving new contracts.
Yeah. Plus, they are rolling out Purple AI to act as an agentic SOC. So basically, instead of a passive tool, it is a virtual team member that autonomously hunts threats.
Which gives them a totally separate way to monetize. But look, pivoting to an AI-first platform is not cheap. To fund this, they announced a major operational shakeup on the call.
Right, an 8% workforce reduction. It is expected to yield about $45 million in annualized savings.
Though there is a $25 million one-time charge hitting in Q2.
Exactly. But it is a deliberate reallocation. They are cutting legacy go-to-market overhead to purposefully reinvest in these AI and data initiatives.
Right. And analyzing management's tone on the call, they sounded highly confident in their Singularity platform and their path to the Rule of 40.
But they were notably mindful about ongoing macroeconomic and geopolitical uncertainties.
Yeah, acknowledging that those factors are still extending deal cycles. So let us look at the valuation using a reverse DCF. For those listening, while it is not an exact science, it indicates what growth the market is currently pricing into the stock. Walk us through the math.
Sure, so at the $17.95 share price and a $5.32 billion enterprise value, we use an 11% WACC and a 3% terminal growth rate.
Which implies what for cash flow?
The market implies a required free cash flow KGR of 28.2% over the next 10 years.
We really need to assess the feasibility of that. With current ARR growth at 23%, hitting 28% FCF growth is ambitious.
But it is doable via operating leverage.
Right. Achieving mature FCF margins of 25 to 30%, which is akin to CrowdStrike, makes the valuation look fair, provided growth stays above 15% and pricing is not eroded by competitors like Palo Alto.
The cash flow dynamics do currently support that leverage.
Which brings us to the final echo for today. SentinelOne is successfully pivoting from pure endpoint to a diversified AI security platform. The long-term investment story hinges on realizing massive operational leverage without sacrificing market share to legacy incumbents.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.